All right, let's dive right into this explainer and uncover the actual mathematically proven path to building $1 million net worth. I mean, have you ever stared at your bank account and just wondered if you accidentally signed up for a subscription service called Broke Life Premium? You know, you work hard, you try to be responsible, but that magical six-figure savings goal just feels completely out of reach. Well, today, we're going to look at the hard data and see exactly how we can completely flip that narrative. We've got a really fascinating roadmap for this explainer. First, we'll diagnose why most people stay broke, then tear down the illusion of the genius investor, build a rock-solid wealth foundation, look at some savings accelerators, and finally, map out the literal path to $1 million.
But before we start talking about millions, we really need to look at this jarring statistic. Right now, 1 out of every 3 Americans literally cannot cover a basic $400 emergency. Think about that. That's less than what most people spend on a monthly car payment, yet it represents a total financial catastrophe for millions of working adults. And the crazy part, this fragility spans across all income levels. So we have to ask, why is this happening?
Section 1. Why most stay broke. The stark reality is that being broke isn't always about your income. It's mostly about daily behaviors and a lack of clear goals. Because when you operate without a financial destination, literally every spending choice you make is just arbitrary. A lot of us fall into the trap of spending money just to create the illusion of success. You know, buying luxury cars or flashy watches just to impress people at work. But honestly, the most insidious traps are those expensive, totally normalized everyday habits. Take a daily pack of cigarettes habit, for instance. At roughly $250 a month, that costs, wait for it, $30,000 over a decade. 30 grand. And that doesn't even include the massive compound growth that money could have generated if you had just invested it instead.
And that brings up another massive trap, the failure to distinguish between productive debt and destructive debt. Because look, not all borrowing is the same. Productive debt is used to acquire assets that actually generate income or appreciate over time. We're talking real estate, a smart business loan, or high-value education. Destructive debt, on the other hand, that just funds a lifestyle you can't actually afford. It's putting vacations on credit cards or taking out massive loans for vehicles that lose value the absolute second you drive them off the lot.
Section 2. The illusion of genius.
To really grasp this, let's look at 2 totally different types of investors. First up, meet Dave. Dave's been trading for maybe 2 years, gets lucky on a crypto meme coin, and suddenly he thinks he's the next Warren Buffett. He's out there lying to his broker to get options approval, leveraging himself to the absolute max on out-of-the-money Tesla calls, basically treating his portfolio like a slot machine. Now, contrast Dave with the actual wealthy approach. This is the boring but wildly successful investor who just quietly buys broad market index funds every single month, letting capitalism and time do all the heavy lifting. So why is Dave's strategy so incredibly dangerous? Well, it comes down to a concept called beta. Beta simply measures a stock's volatility compared to the overall market. So if the market goes up 2%, a high beta stock like Amazon might shoot up 2.66%. Dave's temporary success during a massive 17-year bull market is driven entirely by these high-beta, highly volatile assets. He totally thinks he's a genius. But when the market inevitably turns, and it always does, gravity kicks in. A high-beta portfolio is going to crash way harder than the broader market, completely wiping Dave out while our boring, consistent investor just stays the course.
Since predicting the market, trying to perfectly time your buys and sells, and chasing those high beta trends is just a massive recipe for disaster, how do we actually escape the whole paycheck-to-paycheck cycle and build lasting wealth?
Section 3. The Wealth Foundation.
If you want to build wealth fast, you absolutely have to plug the biggest leak in your financial bucket. And for most of us, that is housing. A ton of people are spending 40, 50, or even 60% of their monthly take-home pay on rent or a mortgage. At that point, you're essentially just working to keep a roof over your head. Optimizing your housing costs, maybe getting roommates, moving to a slightly less expensive area, or house hacking to bring that slice below 30% of your income, that is exactly what frees up the massive capital you absolutely need to start investing.
Section 4. Strategies to accelerate savings.
Okay, so now that we've optimized our housing and freed up some actual cash, how do we accelerate our savings toward that first 100 grand? Look, wealth building isn't about eating instant ramen for the rest of your life. It's about making really smart, high-leverage moves. First off, you got to maximize your employer's 401k match. If they offer a 50% match, that is literally a guaranteed 50% return on day one. You also need to ruthlessly avoid lifestyle inflation. When you get a raise, please don't immediately go out and upgrade your car or get a fancy apartment. Treat at least half of that new money as a tax that goes straight to your future self through automated investments. Combine that with low-fee index funds, and you're building an absolute powerhouse of a system.
The absolutely crucial takeaway here is the sheer power of resisting instant gratification. Over the past century, the historical return of the S&P 500 with dividends reinvested is about 10.7%. But if you took those dividends as cash to spend instead, your return drops to 6.6%. That is a massive 4% difference, and over a 30-year investing timeline, that seemingly tiny gap compounds into hundreds of thousands of dollars in lost returns. You literally have to let the snowball roll.
Once you systematically apply these strategies, you're going to cross a huge psychological and mathematical threshold, one that was perfectly captured by Warren Buffett's longtime business partner Charlie Munger. He said, "The first $100,000 is the hardest." And it's true, because you are doing all the heavy lifting. Every single dollar comes from your own sweat and discipline. But the magic is, once you cross that line, your money finally starts working almost as hard as you do.
Section 5. Path to 1 million.
All right, let's look at a totally realistic setup. Let's assume you've used our foundational strategies, you avoided lifestyle inflation, and you found just $100 a week to consistently invest. That's about $400 a month, which is really just the cost of dining out a few times and maybe some random impulse purchases. We're going to invest this in a broad market index fund, projecting a very conservative 8% annual return, which, by the way, is actually adjusted for inflation.
When we actually map this out, the timeline is just absolutely incredible. Starting from absolute zero, it takes a grinding 12 years of consistent weekly contributions to hit your first $100,000. But to double that and hit $200,000, it only takes about 6 more years. The math completely shifts in your favor. And here is the absolute craziest part. At $100,000, you are mathematically 1/3 of the way to $1 million, all because of the exponential power of compound interest.
By year 36 of this consistent $100 a week habit, you've officially hit that coveted 7-figure milestone. But here's the kicker. Out of that $1 million, you only personally contributed about $187,000 out of your own pocket. More than 80% of your wealth, over $813,000, came entirely from compound growth. Think about that. Your money is now generating roughly $80,000 a year in returns alone, without you lifting a single finger.
The math simply doesn't lie. You don't need to be some sort of Wall Street financial genius, and you definitely don't need to perfectly time the market. It really just requires patience, consistency, and a totally different relationship with time. So the only question left for you to answer is this. Are you going to continue the habits of the broke, spending your hard-earned money on appearances and destructive debt, or will you start making the boring, consistent decisions today that will absolutely make your future self a millionaire?